Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Jobs Friday when we don't have any jobs data. We're going to jump into that, but first I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast, and you're all in your 49ers gear.
Dub City! Niners win in SoFi! Sorry, I'm a huge Niner fan. That was just great last night. For those that follow my social media, you can know I'm just constantly watching the game and posting videos. So anytime you can beat the Rams, it's a great thing. But when you can beat the Rams without your starters, and I couldn't even name some of the people that were on the field, that was wonderful, right? And to win it on fourth down, just good stuff.
No, it was hilarious. You and I were talking before the game, and I was like, they're going to call you in, Logan. They're going to be like, you're going to be like, Coach, put me in. Because, like, literally, who are those people on the field?
Hey, listen, I could play DB and strong safety, and I could play the slot wide receiver. So they were losing a lot. Three of their starting wide receivers weren't there, so I could have caught those underneath patterns against the Rams defense.
Listen, you're going to be next. You're definitely going to be called out there. Oh my gosh. Okay, well, let's talk about jobs and the lack of Jobs Friday data. Has that ever happened before?
Oh yeah, we've had shutdowns where there's no data available. So you know it's interesting because this week everyone's so focused on labor because of monetary policy, right? Because it looks like the entire country is now labor over inflation, right? You know, and so there's a particular look now into all the data because the jobs data has gotten noticeably worse in 2025. Right. And I think some of that needs to be explained. But the article that I wrote was just basically showcasing everything that you could possibly think of without this report. Because a lot of us were trying to figure out what would Jobs Friday be with all the data that we have. We've even gone to other private sector labor data, and it looked like possibly it could have been 45 to 55,000 jobs created in that report. We'll know whenever. I mean, who knows? By Monday morning, you know, we might even get the jobs report. But in any case, there needs to be an explanation of this because of you know Trump's demand for lower interest rates, Powell saying the labor market was solid and then saying it isn't anymore. What happened here out there? But it's been the same story that, you know, you and I have been talking about for some time now.
It has. It's so weird. Like, I know you were looking at different data sources. So let's talk through some of the things that you're looking at. So one of the things that you looked at was like the GDP, like some of the larger economic factors that could affect the labor market. I mean, things are still kind of good. And when you look at like consumer, what people are buying and things like that, correct?
GDP is above 3%. The domestic consumption expenditures or the final sales of GDP, which the Fed really likes to focus on, isn't spectacular, but it's good enough to keep things going. So if you just looked at GDP and some of the consumption data line and then the stock market, you're thinking, okay, there's nothing's wrong. But the labor market has been softening since 2023. Now, last year, what happened was that the labor market was egregiously beating my estimates last year. And I thought, okay, I'm just going to wait for the revisions to see. But last year, even though the jobs data was revising lower and coming in lower, it looked right to me. You know, I was just looking for 140 to 160,000, you know, jobs per month. Based on population growth, the labor market's slowing down, everything. So we got everything that I thought last year. This year is not the case. Early in the year, we even talked about, you know what, this is the first time, you know, the labor data is noticeably under my estimates. So there's your first trigger. Something went wrong in the data. And then the Federal Reserve kept on saying solid labor market's fine, everything. And then all of a sudden, you know, it got to a point where they couldn't come out in public and say that anymore. Even Beth Hammack, who I question a lot of things about Beth Hammack, but in any case, she even had to say that there's some fragility in the labor market. And I think so much of what the Fed is doing is they're putting way too much of the blame on population growth slowing down and not looking at the aggregate data for some time right now.
I think this is the weird thing about this. Everything's weird about this year. Okay. I'll just say that. But like in a normal year, we would look at like, you have a model, I'm sure, for like, okay, this, this is the kind of the slope of the curve, if we will. This is what's declining or increasing on the jobs. And so you would be like, okay, now this month, but we had those pretty big, misses this summer. And then we have all those other variables. So from your perspective, is it much harder right now to even say what this could be?
No,
Okay.
it's the same story since 2023. The labor market is softening, but it's not breaking. And
Okay.
the whole concept of labor over inflation is that the Federal Reserve needs the labor market to break, and breaking has certain parameters out there. But I would say this: we have sectors of the economy that are losing jobs that are are what we consider to be late cycle labor data. And when you have, I mean, it's not shocking to me that job growth is this slow when the two sectors that I focus on are losing jobs. And for the Federal Reserve to keep on saying solid labor market, solid, oh boy, when you start getting negative ADP reports and really big misses on the BLS reports, then you have to kind of look and see, okay, what's going on here? Well, we have weak hiring. Well, also the trade war itself, it's the same thing in 2018 and 19. Can businesses make decisions, when they don't know what the rules are? That was one of the things
Yeah.
we talked about this year.
Okay, so I think you've just made my point, which is you did not, no one predicted the kind of jobs numbers that we got in July.
No, I think it's the revisions that everyone is getting worried about, and then now we're having headline numbers come in as misses, right? So this has been happening since the start of the year, but again, I go back to that one jobs report where the government, federal or state hires
Oh, yeah.
actually blew out the number. And I said, we wasted an entire year because Jerome Powell is old and slow and puts way too much emphasis on one jobs data that was state and federal hires and just ignored it. And now he can't. And the beauty of it is that his arrogance 2 meetings ago, when he dismissed everyone's concern about the labor market, and even today, we're still seeing Austin Goolsbee say, well, we're not going to front row rate cuts. The labor data, is still intact and our unemployment rate is 4. They need to get the labor market to break, right? And once it's broken, then all of a sudden you're going to start to hear different things, but they will hold things as tight as possible until that happens. So as the labor data was deteriorating, they purposely chose to know that to the point where you cannot come on TV and say it's no longer a solid labor market. And that's what Jerome
Right.
Powell did. Even though a lot of us were talking about this, that the aggregate data doesn't look like a solid, the man said it all the way to the very end, right? So that is something that the institution has to revise something and go, well, if we think this is or that is, if that's deteriorating, and a lot of this is housing. It's only now that they're going, it appears to be the housing market is, struggling, in that. Now, thankfully, the long end of the bond market is doing a lot of their heavy lifting and bringing yields down and mortgages. But imagine if mortgage rates were still at 7.25. They'll still go, hey, listen, the unemployment rate is low, consumption is fine. So it's an awkward year in that. But part of that is that they kept on saying the labor market is solid. And when you
Right.
use that term, it just becomes, what happened in such a short amount of time that you have to reverse that?
I think the other thing is, since 2022, you have been the one calling out like they do not care about housing. Housing is not part of their mandate. They don't care about housing and they're fine. It went into a recession. It's been in a recession since then, and that's fine with them.
The existing home sales market doesn't go into their mandate of price stability or employment, right? There's just not enough. There's not enough people employed in that sector to really move the needle. But because it's existing home sales is more of what we call a transfer of commissions. That's how people make the money. In terms of GDP and construction jobs and big ticket item purchases and those need, that would be the new home sales sector. So finally, even some of the more hawkish Fed presidents are noting that, well, it appears to be that supply is high and labor is being hit, and it's weak in that sense. So there's finally some acknowledgments, but I think that, we show that chart how many years now. We said usually residential construction tends to fade before a recession, but you never want to see residential and manufacturing start to fade together. Well, manufacturing jobs have been lost since late 2022, which I did not know. Not a lot of people knew that was happening. But since late 2022, that's been falling. Nothing spectacularly big or anything, but still declining. Now specialty contractor trade. Now residential Now, thankfully, again, mortgage rates have got towards 6%. The demand is starting to pick up. And that's really, it's just this back and forth all the time. But the problem with the residential side is it was a supply issue. This is why we talked about that in the beginning of, or at the end of last year, that the builders are going to be in trouble because there's the supply that matters to them actually is picking up. And that hasn't been the case for the last 14 years.
It's actually a testament to how strong the economy is. You talked about GDP. If you think about all of the things that have happened, okay, we have manufacturing jobs being lost. We've got some construction jobs being lost. We're going to have these government jobs being lost, although we don't know how many. We have had tariff impacts, and still, it's not like we're in terrible shape.
Household balance sheets.
Yep.
Go all the way back to 10 years ago, and to this day, still, people don't understand how well household balance sheets, because they see the credit card data, they see delinquencies, and the scale of it is 5 to 10% delinquencies on X, but they don't realize that 90% that's still doing everything is held up well. So you have good household balance sheets from homeowners. You have deficit spending still. Mandatory payouts are much more just because we're older as a country. And you have the AI boom. So there's a lot of CapEx from that. You put those together, that's very formidable. So even with everything we have, the labor market isn't breaking, right? Breaking, we always said, jobless claims, 323,000, 4-week moving average, don't go into the recession shock. If that was the case, it's a whole different story, because the bond market would basically get well ahead of the Federal Reserve, which it's tried to do a few times in the last few years. And then the Federal Reserve has to make a decision at that point. Do we ignore rising joblessness? See, that's why I've always wanted to highlight that 323,000 4-week. There's going to be a point in the future where they have to make that decision, right? And for now, that data line is still low enough where they feel comfortable with everything. This is why you get a lot of pushback lately from a lot of Fed presidents. Lori Logan, the Dallas Fed, was like, we better not cut rates a lot, because then we might have to raise them again. And again, they just can't get to that next stage until they see Americans losing jobs in a bigger fashion.
Listen, I think it's pretty interesting and brave for Fed governors to be talking about how they're not planning on cutting rates, because that does sort of put a target on their back at this point.
Well, it really depends on voting, not voting. Stephen Meyer, when he's talking about disinflationary factors, he's saying that, well, we are going to force a lot of people to leave this country and not allow a lot of people in. So the disinflation policies of President Trump is creating more supply for housing, and that will be disinflationary. Now, of course, that also means that demand for future construction starts to go away, because if your rental supply is picking up, right, and then your rents might not be there, you really need the numbers to work. So the cost to do business has to really be beneficial in that environment. So there's two fronts on that you'll get the disinflation from having more rental supply out there, but also that's do the builders go, hey, listen, there's enough supply, we're not going to build. So it's never such a clean and easy choice with that. But Uh, that war is just starting with the Federal Reserve and Trump and who's going to be the next Fed chairman, and that's going to be a popcorn event in 2026 for sure. But for now, everything is still somewhat intact. We just have sectors of the economy that haven't done well in terms of creating jobs, and those are things that in previous cycles they'd be really flagging red flags. But consumption is still there. As long as Americans are consuming, this is why the early recession calls because of Godzilla tariffs. A lot of people thought there's no way if we did Godzilla tariffs and kept them as is, eventually when the prices come down, the consumer couldn't handle it. It's never so clear and easy. That's why you have to take all the data one day at a time and move forward. Obviously, there's been a lot of things out there that are different. President Trump talked about checks again, giving $1,000 to $2,000 checks to households. You're going into the should we give checks out, lower rates? We have to give $10 to $12 billion to farmers. It gets a little bit murky out there on what's really happening or how we can mitigate damages for the trade war and all that stuff. But for right now, consumption is still holding up in general terms, and you still have the AI capex boom, and it's a lot of money being thrown into the system, and household balance sheets are still flush, and stocks are at all-time highs, basically. So we could still keep this going now that the 10-year yield is lower and mortgage rates are lower. Housing demand picks up a little. Maybe we could get construction going. Maybe we could get housing permits growing again in this country, but we'll see.
Okay, so we are recording this on Friday. This is going to go live on Monday, assuming that nothing happens over the weekend for the shutdown, which I think is pretty safe assumption. But what do I know? What data would normally come out next week that we're not going to have?
CPI inflation.
Okay.
So we won't have that either. Now, again, there's a lot of private sector data that gives us an idea. I mean, I even looked at a brand new labor sector, and it had jobs growing this month. It's interesting because as long as it's above one job created, Jerome Powell will be happy because it's down to 0 to 50,000. So that's okay now with population growth. By the way, the whole population growth thing is, the labor data was getting softer with good enough labor force growth, but manufacturing jobs were being lost during that whole time. So don't put all the eggs into the population growth story, right? Because that's not the case. Housing permits are at recession levels. So yes, construction gets hit. Manufacturing jobs were being lost late 2022. So there are sectors of the economy that aren't growing jobs, but they're shedding jobs. So it's different, right? We have 162 million people still working, right? Consumption is our game. If you get a lot of AI capex spending, I mean, my God, the data centers that need to be built, electrical grids, as long as they can consume. This is why Trump wants lower rates, right? He needs consumers to keep spending, even if prices go up on goods inflation out there, and that'll keep things going. And remember, inflation means prices go up, right? So corporate earnings have the ability to grow their earnings to a degree as long as demand doesn't get hit.
Amazing. Well, Logan, thank you so much for being with us today on this Jobless Jobs Friday, or at least what should we say? Dataless Jobs Friday?
No, let's say celebrating the Rams' loss to the Niners. And when the Rams running back gets a little bit lippy, he reminded me of the housing crash people, right? He scored a touchdown. He started bragging and everything. And then he fumbled at the 1 yard line. And then on a 4th and 1, when the team needed him, too small. Can't get a job. It's like our little live presentations we do about foreclosure data. Wow, the Rams and the housing bubble crash people kind of
have something in common.
Way.
Yeah, no, that's right. And speaking of which, when you're coming in town next week, when this airs, like the next day, for our mortgage banking summit, which will be amazing, and you are going to talk about what the bleep is going on in the housing market. Something we desperately need to hear. So, Logan, thank you again for being on.
My pleasure. Go Niners!